It feels like subject to investing exploded last year as everyone was looking for ways to avoid high interest rates. With this strategy, there are some opportunities, but what are the risks? And is it legal? And what do you need to know and ask before you take on a subject to deal? Hey friends, it's Dave. Welcome to On the Market. Today we are bringing back one of our most popular videos of the year, our conversation with Eddie Speed about subject to investing. As we head into another year and adjust to the sort of new normal of somewhat higher mortgage rates, which are currently hovering around 7% right now, we want you to understand and stay smart about this strategy. So with that, let's bring on Eddie. Eddie, welcome to the show. Thanks for being here.
How you doing, Dave?
Great. Very happy to have you.
Thank you.
Let's have you start by telling us a little bit about how long you've been investing and when did you first learn about creative finance and specifically the subject to strategy?
Well, my original business was I'm a seller finance note buyer, and I started doing that in 1980. So I spent a lot of my career working with real estate investors who frequently created seller financing. And so I've worked with, I would say, thousands of real estate investors on creative finance strategies, including sub-2 for decades. This is about 4.5 decades in for me now.
Wow, that's incredible. We got the right person here to talk about what's going on in this creative finance environment and some of the risks and rewards of it. So thanks again for joining us. For those of our audience who may not know, can you just explain a little bit about what subject to is in the first place?
So subject to, the thing that most people call it is sub-2, which is it's just a shortened way of saying you are taking title to a property subject to the existing mortgage. You're not assuming it. You're acknowledging that there's a mortgage. So you're accepting deed to the title subject to the underlying mortgage.
Okay, and so the difference, just so everyone's clear, is that when you assume a mortgage, you're saying, I am taking over this mortgage. It is now mine. The original mortgagee is done, right? They're completely off it. But subject to is different in that basically the original borrower stays on the mortgage, but the person who gets the mortgage subject to basically takes over the payments of that mortgage. Is that right?
Yes, they're not technically legally liable for it. They're taking it subject to, but they are fully aware that if they don't pay the mortgage, then they could lose their interest in the property, right? It's a legal maneuver. It's not an assumption. There's no qualification. Let's be perfectly honest about it. You know, they are not trying to go wave a flag in front of the lender who probably has a due on sale clause. And so they are trying to take over the existing mortgage because of rates. They're trying to take over a low interest rate mortgage and take advantage of paying that debt back versus paying cash or go getting a more expensive mortgage.
Eddie, that's always been my concern and why I haven't really looked into this that much because of that due on sale clause. But it sounds like banks haven't been calling it, but they've also not had 2% interest rates. So is that a risk?
100%. I mean, that's the risk. The risk is you're taking over a very advantageous loan at a low rate. The risk is you do something and you now trip the due on sale clause and alert the lender, and we can talk about what those likely scenarios are to most likely trigger the loan. And that's exactly what it is. This is not for amateurs. This is not for beginners. Your first deal probably doesn't need to be a sub-2. So it's a market condition. Savvy investors do it. They're usually in a position, Kathy, if something goes wrong, that they can write a check and solve the problem and pay off the underlying mortgage. And so that really starts qualifying like who really is a candidate for this strategy.
Oh my gosh, that's such a good point. Yeah, having that backup plan.
Eddie, I'd like to just talk about some of the basics of subject to for a minute here. Can you just tell us, why would a seller agree to this?
Because they need to get out of the trap.
What trap is that?
You know, like we see it all the time. Somebody's in the military, they get transferred. Like their life's changed. You got to move. You got to, and so we're now in a market where rates are much higher and affordability is very different, and they need to get out of it. and I've been around the business. I'm in 3 masterminds that I would say safely, probably 80% of the top 500 house buyers in those masterminds. And so I hear these stories a lot. And the people just need to be in a situation where they can move on. If properly done, they've been fully explained, have had fully explained to them exactly what's happened and what you're doing, right? Now, do you think that everybody that's done a sub 2 has done a super clear job of doing that? I have some doubts, but I would say that if anybody that has done this, that is taking responsibility and doing the right thing, they've explained the scenario and they're saying, this is a risk you're taking. You need to fully understand the risk. And if this is an acceptable risk, then this might be a strategy to let you get out of the trap. And by the way, you're not going off the mortgage and you're not going off the credit report. You still are responsible for the debt.
So if the person who assumes the mortgage just stops paying their mortgage, then the original borrower's still on the hook, right?
Absolutely. And they didn't assume it, by the way. Remember, they did it sub 2.
Okay, so now that we're clear on what the subject to strategy is, let's dig deeper into its potential risks, legality, and why people might consider this strategy in the first place. Eddie's going to take us through it all right after the break.
Welcome back to On the Market. We're here with Eddie Speed talking about what investors need to know about subject to. So let's jump back in.
Now, as Kathy said, the due on sale clause here is obviously one of the big risks that we want to talk about. So can you just tell us what the due on sale clause is?
Today, they write into the mortgage that it has a due on sale provision, meaning it's a covenant in the security document, the mortgage or the deed of trust. And it simply says, if the transfer of title transfers, then that loan is due. Now, there's a provision in there that also allows for you to transfer the property into a trust under Garn St. Germain. So there is a provision that says if Kathy Fedke owns her house individually, she can then transfer that property into her trust. And this is why you commonly are hearing real estate investors are talking about using a trust. Now, to be clear about this, that's Kathy's trust, not Eddie's trust. So, Kathy can have a trust and transfer the property into her trust. It doesn't technically give her the provision to transfer it into Eddie's trust. So it doesn't really sidestep what that covenant in that security document says. Now, by the way, I'm not an attorney and I don't play one on TV. I've paid for about every high dollar law school in the business and legal fees. So I'm only repeating what the attorneys have explained to me. So there's your disclaimer on that.
And has this been an issue? I mean, I'm even scared to transfer my own properties into an LLC because of that due on sale clause, because it's considered a different owner and I don't want to have the loan called and I don't want to lose my 2% mortgage, right? And people always say, don't worry about it. They never call it. Is that changing? Are you seeing anything new?
The provision allows you to put it into a trust. That's what I would do. You can put it into a trust. It doesn't necessarily provide for you to put it in an LLC. So put it in a trust. You could have an LLC as the beneficiary for the trust.
Yes.
So you could figure out how to paper it. So people, if you're listening to this, you're going, Eddie, this is like a legal maneuver. This is like a legal maneuver to acquire property that really isn't totally cool with the servicer that you're doing that. And the answer is that's exactly what it is. So you're saying, are you a proponent of this? I'm saying to you that it is a common business practice for seasoned real estate investors in this environment that we're in, that some of them are doing it.
Eddie, I know you're not a lawyer, so I won't ask you to tell us the specifics of the legality here, but would it be safe to say that subject to properties are legally ambiguous? Like it's not clearly legal?
This is what I've been told. This is not illegal. It is not illegal to do this. There are some things that can be illegal about it, which we can discuss. But it is in the spirit of it is not against the law to do this. You are breaking a covenant in the security document, right? That's different than breaking the law.
Okay, I see. So it's just basically you're breaching a contract. You could be, let's just say, in theory, you could be breaching a contract.
100%.
Okay. And maybe this is a silly question, but if that's the case, why would an investor want to do this?
They're trying to take over a low rate loan.
Okay. So that's the incentive.
And if you have the horsepower to go fix the problem, then it may not be that big of an issue.
Mm-hmm.
Right? If you don't have the horsepower to go fix the problem, they call the note, then you might be putting yourself and the guy you bought the property from, and potentially somebody you may have sold it to on a wrap or a lease option, you might be putting all the parties at risk.
Yeah. So let's talk about that. Let's say that they call the note. And again, my last question, are we seeing this? Are banks calling notes? Because I keep hearing people say, well, of course the banks are going to want to get out of their 2% rates. But are they? Is that true? Do they still even hold the note, or was it sold? I mean, is that even true?
So the servicer is not, a lot of people think they're out running title. That's not what they're doing. They're not running title, trying to go find these things. Something has triggered them doing it, and then they're under a fiduciary responsibility to investigate it. That's really where I think the rubber meets the road. So the question becomes, how does a servicer figure this out, right? What is the trip switch? There's a couple of things that can happen, right? The borrower could get just nervous and just call the lender and go like, oh my God, I can't believe I did this. Like 60 days later, I just did the dumbest thing. That could happen. You ever seen that happen, Eddie? I've seen it happen, right? So they go and rat on themselves. Like you wouldn't think they would, but I've seen it happen, right? That can happen. Here's another thing. This is very common. Mr. and Mrs. are getting a divorce. They're walking away from each other. Let's just let somebody take over the mortgage. We're going to walk away and we're going to live our own life. Okay, well, the Mrs. now, 2 years later, she meets a new Mr. She's getting remarried, right? And things are going good and they're going to buy a new house, Dave. And they go down to the mortgage company. And the mortgage company asks them, takes a loan out. And Mrs. never mentions the existing mortgage because that's not hers anymore, right? And then all of a sudden they pull a credit report and they go, what about this mortgage you've got? And she goes, what mortgage?
Oh, yeah.
Do you see what I'm saying? So what if she hasn't signed off that she's fully been disclosed and fully 100% understands it's on her credit report, that she's liable for it? There could be an issue with the insurance, where all of a sudden, like that triggers somebody to make phone calls, and what happens, right? That could be a scenario. 90% of the time, it's going to be the insurance.
Mm-hmm. Okay. And why is that?
Yeah, I had not heard that before.
Who's the insured?
Now I'm confused.
Well, you know, Kathy's rich and probably doesn't have a mortgage, but for us, other types,
You're sweet.
right, that might have a mortgage, right? We're going to have to send our insurance policy to the lender every year, and it's going to say, to protect your interest, Mr. Lender, we've made sure that we insured the property, right? And so this is property insurance. This isn't title insurance. This is property insurance. And the deck page of that insurance is going to say, who is the insured? And if you want to know what likely is going to cause the trip switch, somebody who is not necessarily a decision maker at that servicing shop is responsible for clicking the button and saying, yes, Kathy has insurance, blah, blah, blah. Here we go. And she takes it over to her supervisor and she goes, well, Kathy's no longer the insured. What do I do with this one?
So the person who purchases subject to needs to get new insurance, and that creates confusion with the servicer, and that could trigger just an investigation internally.
Yeah, and there are some things that are stated in the marketplace that are solutions for this that I think are, well, not correct. Okay. So here's what we're going to do, Kathy. I'm going to buy this property sub 2 from you. We're going to keep your insurance and I'm going to pay your insurance premium. And then I'm going to go put another policy against it where I'm the insured. Let me ask you a question. What if the house burns down? Who's going to pay the claim?
That's why we need you, Eddie. We don't know.
You don't think those insurance companies are going to have a problem with the fact that we're insuring Kathy, although she has no other interest in the property, right? You don't think they're going to have an issue with that, right? Or you don't think another insurance company is going to say, oh, wait a minute, you have 2 insurance policies on this house? That's a black hole that I don't even think about. But I know, I've been told this many times, Kathy, from some people that you and I mutually know. I've been told that that's how you fix it. My guys that give me counsel and legal advice on this say that is definitely not how to fix it.
Well, I think that really does bring back to this is sophisticated and you should be getting your legal advice from an attorney.
And one that didn't get it in a Cracker Jack box.
That would be especially helpful.
This is great information, and it's certainly clearing up some of my personal questions about subject to, but who might consider taking on this risk? And what actions can investors take to protect themselves if they're going to pursue it? And he gives us his expert insights right after this break. Welcome back to our conversation with Eddie Speed. Let's pick up where we left off. So Eddie, this has gotten popular over the last few years, obviously because the change in interest rates. It is perhaps more appealing than it ever has been to take over someone else's mortgage. Given everything you know about this, what is the profile of an investor who should think about this type of strategy?
I think you need to be operating at a level where you are making a very informed decision about the strategy and the process and the documentation and the risk associated with it, and that you are prepared for something not to go right and that you're in a position to fix it. Now, there's another issue here that we haven't really discussed that's very important, and that is state statutes relative to borrowers that are delinquent on their mortgage. Because a lot of times, the reason people do a sub 2 is they're behind on their mortgage. So about 50% of the states have mortgage foreclosure protection laws. That means if you're delinquent on your mortgage, Kathy, in your state, for sure, there's consumer protection laws that says in the state of California, if you're delinquent on your mortgage, you're a protected class. You're like a minor.
You know, I thought the opposite was true because in California, you can foreclose in like 28 days or something, unless the laws have changed. I don't know. It's very, very quick here. Yeah, it's shocking. There are places like Pennsylvania where I would never hold a note because you can't foreclose. Florida has been shockingly very difficult, considering the color of that state, so to speak. But California, I always thought was pretty easy. But you're right, Eddie, like every state is different.
All right, so let's go back in history and let's talk about why this happened. Kathy, you remember the old short sale days?
I do.
You remember all these kind of panhandlers that would go get somebody to pay them a fee to go arrange a short sale?
Yeah.
And they were sort of scamming them. They really weren't going to go work and get them a short sale. You remember those days?
Yeah. Oh, yeah.
So a lot of states then adopted delinquent mortgage protection laws so that borrower is a protected class. Now you are in a fiduciary responsibility in dealing with that borrower. So you can imagine, Dave, I'm going to bust out there and go in these states. Now, I don't have a clue whether my state is one of those states or not, right? I don't know what the statutes say because we're just going to ignore all that, or we never even knew to ask. Now, all of a sudden, I find somebody, they're delinquent on their mortgage, and I'm going to write them a check, get them to deed the property to me, and I'm going to buy the property at a discount, right? Now you go back and say, I wonder if some of those mortgage foreclosure protection laws said that my fiduciaries could do that, because now they're in a fiduciary responsibility in dealing with me. Oh, that could be an issue. So this is also risen its ugly head. These are stories that I've heard pretty common where people have gone out and wake up one day and find out Well, apparently this is one of those states, about half of them have this law, and they're all different within the state. So you can't say they're not all written exactly the same. But basically the concept is this. The borrower who is delinquent, sometimes they say foreclosure has been initiated. Sometimes they just say delinquent. But now you've gone out and you've realized that the person you did business with that then allowed you to do a sub 2 was a protected class. I hope I'm making you nervous.
No, yeah.
Yeah.
You are. That's why I'm quiet.
This is why you have to get good advice before you go do this.
And not take it so lightly. The pitch has been, and I know people who've done sub 2 that have done well and have become wealthy. And I've been jealous and like, why can't I have the nerve to do this? But the pitch has been, this is a no money down way to build a pretty massive portfolio with low rates. I mean, and of course it's not always the case, but it's solving a problem, right? Like you said, this person is backed in a corner. They're going to lose the property anyway, possibly, and lose everything. That's the pitch. But the reality is there is risk and people need to know about it. And so let's go back to that of the risk to the seller. Well, we've been talking about the risk to the buyer, to the sub 2 person. What other risks are there? Because now they're on title, they're a fiduciary, so they better have given a fair deal.
Half the states have this, half the states don't have it, and not everybody does a sub 2 is delinquent. So this doesn't mean every person in every state and every scenario has this scenario, but that's a level of awareness I'm very intentionally bringing to the conversation, because I found out this is not a commonly understood thing. Once again, I'm not an attorney, but Kathy, I've had quite a bit of dealings with people that specialize in this. I have been brought in many times to go help evaluate the risk management side, even from the attorney's perspective, because I've seen this so much. I've seen so many people that have done it because I've sort of seen what can go wrong. As you said, Kathy, I've seen people that have done it really well with it. I've seen people that have not done so well with it.
Yeah, I mean, really, to me, it comes back to ethics. Like if you are giving a fair deal to this person and you are acting as a fiduciary, where you do give them some cash if there's equity in the project, or if there's not equity, you've just relieved them from this debt, and you can prove that. But how could it go wrong, even if you've kind of done it right in that regard? Like, what if it doesn't perhaps perform the way you thought and you can't make those payments? Or I don't know. What are more risks?
The first thing I would say to you is, Kathy, go up in front of a judge, and here you are, a real estate investor that came up with this really clever idea. And then you got these people that you got to essentially sign over your property and take over their mortgage. Now something's gotten messed up. Who's going to be perceived as the opportunistic person here?
Right.
Who's going to be perceived as not so reasonable? So now you can see where lawyering this up becomes pretty important.
Yeah, that's the only real way to protect yourself, right? Yeah, there's no shortcuts to this. If you're going to do this, you need to be speaking to an attorney and making sure that everything you're doing is legal, ethical, all of that.
Yeah, and this is not something that most real estate lawyers have a high experience in, or I don't want to say they're incompetent, but they're not specialized in this field. Mm-hmm. So this is not something that just you go in the yellow pages. They still have yellow pages, right? They don't have those anymore, right, Kathy?
I don't know if they have those. Yeah.
You go look for a lawyer, and okay, well, this guy's he's not the guy, right? And so that's kind of the areas that we've seen. So you can do this where you believe that you have identified the risk and you've managed the risk. Identifying there is a risk, right, Kathy? Very clearly identifying there's a risk associated with this. And then there's a way you can do it where you've kind of blindly not even assumed the risk. And that's somewhat like crossing the highway with a blindfold on, right? It just may not work out for you. As an industry person, that's what I want people to get. I don't want to make this sound like it's so easy that anybody that can spell real estate can do it. I don't want to sound like it's so impossible that I think I haven't seen people that are successful, because I have.
Right. All right. Well, Eddie, thank you so much for sharing this information. This is really helpful. You bring a level of expertise on this subject I had not heard before, and really appreciate your words of wisdom and caution to real estate investors. If you want to learn more about Eddie, we will link to his website and information in the show notes as always. Thanks again, Eddie.
Thank you very much.